Makes it really simple. It's not like they have lots of choices. They don't. There are not lots of choices. There's one way. And there's one way to revalue a currency as well, and that's against gold. That's the way they do it. So honestly, it makes it super simple when we're looking at things to determine what is going on and where are we in this trend cycle. When they installed the Federal Reserve of 1/20th of an ounce of gold, back $2.40. So they printed a whole lot of new money. You can see that right here in the money supply, almost double, okay? Roaring 20s. Now, all of this money is in the circulation, and that's what created the roaring 20s. Remember, you've heard lots of it. And then, of course, in 29, we had the stock market crash, okay? So by the time all of the money got into circulation, it was 215% of what it was when the Federal Reserve kicked off. And then, okay, 12/30, 1928, just before the stock market crash, look at the shift. Look at the shift right here in the CPI, all right? We was already at a downtrend. Pattern shift, pattern shift, pattern shift. They mean something. And then, of course, the money supply declined and the stock market crashed and the GDP went down. But I think for the general public that was mired in that Great Depression, these were not good times. But that isn't true for everybody. And that's the point that I want to make here. If you are in the right place at the right time with the right asset, as we go through these crashes and these crises, you are going to have the opportunity to grow your wealth base in wealth that you cannot outlive, which also means if it matters to you, which of course everybody knows it certainly matters to me, that, I'm trying to prepare for my heirs, because what they have in mind for my children, my grandchildren, my great-grandchildren, and on is not a world that I want to leave them. I want to leave them with the ability to have freedom and make choices and to dream and have their dreams come true. And that's why I'm doing everything that I'm doing. It's not for me. I'm old. I'm only going to be around for another probably 31 years because I think I'm going to live to be 100. But it's going to be my children and my grandchildren and your grandchildren and all those children after us that are going to deal with the consequences of the choices that we make today and the choices that the central planners make today. Because you got to ask, did the M2's dramatic decline lead to the Great Depression? And is that what's going to lead to the greatest depression that we're now entering? This is the end of the currency's life cycle, so you can make that comparison, right? So this goes back to August 31st of 1969, shortly before, there was already a run on the dollar that was happening, but shortly before President Nixon took us, I know they say this so nice, took us off the gold standard. Oh, well, that's no big deal. Yeah, it is, because he handed over full control to central planners, to central banks. There's 2008. Now, what I want you to notice here is how that CPI was running a bit ahead. I mean, pretty parallel, but still a bit ahead of the money supply. And in 2008, which is when the system died.
Lynette Zang provides a compelling analysis of the financial system's reliance on gold for currency revaluation, highlighting its enduring significance through historical examples. By examining the Federal Reserve's actions since its inception, Zang demonstrates how gold has been a cornerstone in stabilizing currencies and guiding economic policies. When the Federal Reserve was established, 0.20 ounces of gold backed each dollar, and the money supply saw a significant increase. This influx of money led to the Roaring Twenties, a period characterized by economic prosperity and speculative investments. However, this boom was unsustainable. By 1929, the stock market crashed, leading to the Great Depression. Zang emphasizes the importance of recognizing economic patterns. For instance, she points out that before the stock market crash, there was a noticeable shift in the Consumer Price Index, CPI, indicating a downward trend. Such pattern shifts are crucial for understanding where we are in the economic cycle. The decline in the money supply and the subsequent stock market crash had devastating effects on the economy, plunging it into the Great Depression. Despite the economic turmoil, There were opportunities for wealth preservation and growth for those who were positioned correctly. Zang highlights that being in the right place at the right time with the right assets such as gold allows individuals to protect and grow their wealth during crises. This strategy not only safeguards one's financial future, but also provides a legacy for future generations. Zhang's motivation extends beyond personal wealth. She is deeply concerned about the future for her children, grandchildren, and great-grandchildren. The decisions we make today, influenced by central planners, will have lasting impacts on future generations. Zang stresses the importance of preparing for these future challenges by making informed decisions about wealth preservation now. Zang draws parallels between the dramatic decline in the money supply during the Great Depression and the current economic situation. The significant reduction in the M2 money supply raises concerns about entering a similar economic downturn. This is particularly relevant as we approach what she terms the end of the currency's life cycle. In 1969, before President Nixon took the U.S. off the gold standard, there was already a run on the dollar. This historical context is crucial for understanding the long-term impact of removing gold backing from the dollar. When Nixon closed the gold window in 1971, he handed full control to central planners and central banks, marking a significant shift in economic policy. Zang argues that the financial system effectively died in 2008, a sentiment echoed by many financial analysts. The massive increase in the money supply and the resulting inflation have not significantly impacted the GDP. This disconnect suggests that the money distribution system, particularly the trickle-down theory, has failed to stimulate broad economic growth. The trickle-down theory posits that giving money to the wealthy will eventually benefit the broader population. However, Zang argues that this approach has consistently failed. In the recent financial crisis, the government tried a different tactic by directly giving money to consumers. While this provided temporary relief, it did not address the underlying issues of economic inequality and instability. Despite holding interest rates at zero for 15 years, central banks have created the next crisis by flooding the market with low-interest bonds. As interest rates rise, the value of these bonds decreases, rendering many banks, including the Federal Reserve, effectively insolvent. This situation highlights the limitations of current monetary policy tools, money printing, and debt creation. Zang argues that the current financial system is unsustainable and must shift to a new model. The dramatic increase in the money supply has not resulted in significant economic growth, signaling the need for a new approach. The parallels between current economic indicators and those of the 1930s suggest that we may be heading towards a deflationary period, which will require inflationary measures to counteract.
I don't care what anybody says. It's when the system died, and you can see the shift. And it takes more and more and more money to get greater and greater inflation. And again, has all of this money and all of this inflation has frankly barely moved the needle on the GDP, which could be how that all of that money is distributed to everybody. So forever, the central planners were using that trickle-down theory, where is if we give all the money to the people at the top, then they're going to go out and spend it, and it's going to trickle down to all those people, the 99% on the bottom. And it doesn't work, and it hasn't worked, but they still do that. I mean, they tried a little different in this last crisis by giving money to the spenders because we are a consumer-driven economy. So they had to do something. But you can see how much more. That's when I say it's like pushing on a string. It doesn't matter how much more money they create now. They are out of tools. They've held interest rates down to ZERP for 15 years? And that has created this next crisis because all of those bonds, remember, interest rates, principal value. So as the central banks were raising up those interest rates, the market value of all those bonds that they put out at zero went down, meaning that all of the banks, including the Federal Reserve, is insolvent. They're insolvent. And that's supposed to be the lender of last resort. And all they have is this. And I know a lot of people get annoyed when I use this, but this is all they have. This is all they have. That and interest rates, right? Here's the theory. You want to increase inflation, then you reduce interest rates. That inspires more borrowing and more spending. You want to slow down inflation, you raise interest rates. That reduces borrowing and therefore spending. Those are the tools, money printing and creating more debt. So this debt is not payable. And we're looking at it at the beginning, and now we're looking at it at the end, and we're looking at the shift in monetary velocity, because there's been a 3,680% increase in money. But that really hasn't helped a whole lot, has it? Has it? Do you see why we have to shift into a new system? Do you see that we are shifting in to a new system? Because that's gone down right about, this has gone down right about the same level that we saw back in the 30s. Is the great deflation coming? What are they going to call it? Who knows? But this is massively a deflationary signal. And there's only one way to fight inflation. That's with deflation. So, hey, they're raising the interest rates. It's working. But there's only one way to fight deflation, and that's with inflation. So it makes it really simple. It's not like they have lots of choices. They don't. There are not lots of choices. There's one way. And there's one way to revalue a currency as well, and that's against gold. That's the way they do it. So honestly, it makes it super simple when we're looking at things to determine what is going on and where are we in this trend cycle.
Zang makes it clear that there is only one way to revalue a currency, and that is against gold. This method simplifies the complex world of financial systems, offering a clear and proven path to stability. Throughout history, gold has been the foundation for revaluing currencies, making it a critical asset for investors looking to safeguard their wealth. The historical context of gold's role in currency revaluation provides valuable lessons for today's investors. When the Federal Reserve was established, it linked the dollar to gold, which helped stabilize the currency and spur economic growth. However, as we saw in the 1920s and 1930s, this link can also lead to significant economic challenges when not managed properly. During the Great Depression, those who held gold or other tangible assets were able to preserve and even grow their wealth. This historical example underscores the importance of diversifying investments and holding assets that retain value during economic downturns. Gold, as a timeless store of value, offers this protection. Zang's message is not just about personal wealth preservation, but also about preparing for future generations. The decisions we make today will have long-term impacts, and it is crucial to consider how we can best protect our financial legacy. Investing in gold and silver provides a means to preserve wealth for our children and grandchildren, ensuring they have the resources to navigate future economic challenges. Zang critiques the modern monetary policies that rely heavily on money printing and low interest rates. These policies have led to significant inflation without corresponding economic growth. The trickle-down theory, which suggests that giving money to the wealthy will eventually benefit everyone, has consistently failed. Instead, direct investment in tangible assets like gold and silver offers a more reliable path to financial stability. The current financial system, heavily reliant on fiat currencies, is showing signs of strain. The dramatic increase in the money supply has not resulted in proportional economic growth, suggesting the need for a new approach. As we face potential deflationary periods, the role of gold in stabilizing currencies becomes even more critical. For individual investors, the current economic landscape underscores the importance of diversifying portfolios with physical gold and silver. These metals provide a reliable store of value, protecting against the devaluation of fiat currencies. Investing in gold and silver also aligns with the strategies of central banks and major economies, which are increasing their reserves of these precious metals. The concept of gold-backed digital currencies represents a significant innovation in the financial world. These digital tokens, backed by physical gold, offer a modern solution to economic instability. Zimbabwe's introduction of gold-backed digital tokens is an example of this trend. While these tokens aim to stabilize the economy, their true value lies in their gold backing. This development reflects a broader movement towards integrating gold into modern financial systems. Digital gold-backed currencies combine the stability of gold with the convenience of digital transactions, offering a promising alternative to traditional fiat currencies. Investors often have concerns about storing and liquidating physical gold and silver. Secure storage options include home safes and professional storage facilities, ensuring the safety of these valuable assets. Liquidity is another common concern. While gold and silver are not as liquid as fiat currencies, they can be easily converted into cash when needed. Numerous dealers and platforms facilitate these transactions, making it straightforward for investors to access their funds when required. Economic shifts are inevitable, and being prepared is essential. Holding physical gold and silver provides a hedge against economic downturns and inflation, offering stability and security. These metals ensure that wealth is preserved regardless of economic conditions. Building a comprehensive financial plan involves more than just investing in gold and silver. It also means ensuring access to essential resources like food, water, and energy. Fostering self-sufficiency and building a supportive community are critical components of this strategy, providing a resilient foundation during times of economic instability. The broader implications of these trends are profound. As more countries and institutions adopt gold-backed monetary policies, gold's role in the global financial system will continue to expand. This shift could lead to a more stable and secure global economy, with gold serving as a foundation for trust and value. However, this transition poses significant challenges. The current financial system, heavily reliant on fiat currencies, will face substantial disruptions. Investors and policymakers must navigate these changes carefully. In conclusion, strategically accumulating physical gold and silver is crucial for protecting wealth in today's volatile economic landscape. These metals provide stability and security, ensuring that wealth is preserved regardless of economic conditions. By understanding the broader economic context and taking proactive steps, individuals can safeguard their financial futures. Investing in gold and silver is not just about short-term gains, but long-term security. These metals have a history of preserving wealth over centuries, making them reliable investments for future generations. By staying informed, diversifying portfolios, and preparing for economic shifts, individuals can position themselves to thrive in a rapidly changing world.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.